The Bank of Canada released their financial system review today, and unsurprisingly, elevated household debt and elevated housing prices are two of the major vulnerabilities to Canada's financial system. That and the fact that the global economy is facing several new challenges, including higher inflation, higher rates, the Russia-Ukraine invasion, and increased financial market volatility. And well, you can say that the financial system in Canada has a lot of things that are making it vulnerable right now, especially as the Bank of Canada increases interest rates. But how's that going to affect housing, and exactly how bad is all of the problems in the housing market? And there's some really interesting graphs and some really interesting data that the Bank of Canada shows today that sheds some significant light on what's really going on in the Canadian housing market. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so welcome back. Today we're discussing the Financial System Review, or the FSR as it is referred to. And this is basically a report that comes out on a regular basis where they talk about the vulnerabilities to the financial system in Canada. And this makes up a pretty big part of how the Bank of Canada guides the policy rates going forward. And really what they're looking out for when they do start doing things like increasing interest rates and the impact that that could have on the most vulnerable parts of the economy. And it's no surprise that elevated household debt and elevated housing prices are showing up on this financial system review, because rising Canadian household debt and rising housing prices have been something that have been a problem for a significant amount of time. The circumstances of the pandemic simply amplified the effect, and we're going to get into all the details of that. But before we do, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our Race to 25,000 subscribers giveaway, where we're giving away $5,000 on July 1st to one lucky subscriber. All you have to do is subscribe to this channel and go to 360giveaway.ca to register for the contest. And you get an extra entry if you follow me on Instagram and if you share the contest socially. So again, 360giveaway.ca. Okay, so let's get into it. Let's discuss the financial system review. First and foremost, what I think is very clear is that the bank's number one priority right now is dealing with inflation. That is it. Now, they're going to have to increase interest rates, and that could potentially have an impact on the Canadian real estate market. In fact, it will. It already has, but they're watching it closely. And it's really interesting, the report that they came out with today, because there's a whole bunch of information here where they shed some further light on what's going on in the financial system. And I'm going to take you through, and I just want to show you some of the graphs and the key messaging here. Because if you take a look at some of the graphs here, it paints a really interesting picture. And let's start first and foremost by talking about interest rates and the 5-year sovereign bond yield. So these are the bond yields that are typically used to price 5-year fixed mortgages, at least in Canada they are. And if you take a look at what's happened with interest rates here over the last couple of years, you can see that the 5-year bond yield at one point was as low as around 0.35%. And in the last few months, it has jumped up enormously to almost 3%. Actually, it's just over 3% as of today. It's at about 3.2. So there's been a pretty significant run up, and this is pretty much the result of it being clear that inflation is embedded in the economy, and that the Russia-Ukraine conflict, war, I know I'm not supposed to call it a conflict anymore, it is a war, the unprovoked invasion of Ukraine by Russia has pretty much led to an amplification of all things inflation because of the energy crisis and commodity crisis that has essentially been created because of the war. And if you take a look at volatility, this is the move volatility scale and the VIX volatility scale. The move volatility scale has to do with bonds. You can see high volatility there because of higher interest rates and the potential for higher interest rates. And the VIX has to do with the S&P 500 index. And as you can see, both of these volatility scales are running significantly higher than what they were pre-pandemic, and running significantly higher than the long-term averages for those scales. And this is evidenced in the fact that the US stock market and the Canadian stock market are down almost 20% off of January highs. And that is because of the extreme amount of volatility in the markets. And this starts with supply chains, and it moves to the Ukraine-Russia invasion. And it just has basically amplified everything that's gone wrong in the economy for the last several months. And to be clear, these are global issues. These are not Canadian issues. Central banks all over the world are in a tightening process. And the reason why they're in a tightening process is because this is a global issue, not a country level issue. Now, the real estate issues that we have, which are the elevated household debt and the elevated home prices, those are with certainty Canadian issues, but Inflation is a global issue right now, and central banks all over the world are increasing interest rates right now. That is not something that is exclusive to Canada. Now, there's some really interesting charts in this report. This is the first one I want to show you, and that is that household net worth has increased by about $230,000 on average since the pandemic began. And if you were a homeowner pre-pandemic, so in other words, if you weren't waiting for the market to drop pre-pandemic and you owned a home, you have increased your net worth significantly due to the rise in your housing value. And in addition to that, other assets have also increased quite substantially since the beginning of the pandemic. And a lot of this has to do with not only the amount of money that was injected into the economy, but the level of savings due to, in a lot of cases, the inability to go out and spend money on things like restaurant dinners and travel and so many other things. So the pandemic had a really, really positive effect on household indebtedness. It had a positive effect on household net worth. And one of the key things that the Bank of Canada is pointing out right now is that one of the big vulnerabilities is for those people who got into the market in the last 6 to 12 months who are highly indebted, don't have a ton of assets, don't have a ton of equity in their home, and in some cases who have variable rate mortgages. And this is where it gets interesting because the loan to income ratio, the number of people, the percentage of people who have a loan to income ratio above 450% now exceeds 25%. So it's about 26.5% right now. Now, if you take a look at the loan to income ratio for people who have a greater than 450% loan to income ratio and a variable interest rate, that number is at 18%. And in addition to that, the number of people who also have an amortization of longer than 25 years is at 15%. So this is those Ontario and those BC borrowers who bought for over $1 million, got 30-year amortizations, and have a pretty significant headwind against them when it comes to being able to make their payments. Now, it's no surprise to most that interest rates have increased significantly over the last few months. This is a really interesting chart because it shows the policy interest rate that was rising quite substantially here leading up to the pandemic. And then all of a sudden it drops off in the pandemic. And now what we're seeing is this period from basically early March to now, we're starting to see that run up in interest rates. Now, one of the questions that we get asked quite frequently is, why didn't we see the rise in interest rates coming? And why didn't I lock in my variable rate to a fixed rate mortgage in March when I had the chance? Well, it wasn't that simple because if you even think back to March of 2021, where you could get a fixed rate mortgage at 1.65% or a variable rate at 1.25%, most people who are already into their mortgages, when asked, would you like to pay a penalty in order to lock your mortgage into a 1.65% fixed rate mortgage, most of them were saying no for two reasons. One, they didn't want to pay the penalty. Or two, if they had that option with the same lender that they were with, which most of them didn't, by the way, they would have had to switch lender to get those super low promo rates. Well, most of them looked at what the Bank of Canada was saying at that time, which is interest rates will remain low for a very long time, well into 2023. And as a result, they had that, 40 to 50 basis points difference between the rate that they had and the rate that they could get. And most chose to stay put because it looked like the long-term prognosis was for interest rates to remain low and that variable rate was going to be a good decision. And then all of a sudden, we look to basically April of 2021, interest rates start to come up and the gap widens. So now I'm paying 1.2% and I have the option to lock in at 2.24%. Well, it's a 1% difference in interest rates. Why would I do that? Especially when the Bank of Canada and the Federal Reserve is still saying that interest rates are probably going to remain low for a long period of time. And then all of a sudden you see this really fast run up in interest rates. The gap is widening, and then all of a sudden, this is where the big spike happens all in pretty much a month. And there was just no point in time where it made a ton of sense for somebody who was taking that guidance of the Bank of Canada, who was saying interest rates would remain low, to switch their variable into a fixed, especially when they were paying 1 to 1.5% lower. And even now, it still doesn't necessarily make sense to take a fixed rate over a variable rate because there's a significant difference between the interest rates. And a lot of people are kicking themselves going, oh, I should have taken a fixed. Well, there's no point in kicking yourself for taking a variable rate because you made the best decision you could with the information that you had at the time. And while hindsight makes it look like there was a better decision to be made, we didn't have that information at that time, and therefore it would have been impossible to predict what was going to happen with interest rates. I know there's going to be a couple guys in the comments who say I told you so. Well, It's not quite that simple, and all the economic indicators were telling us that interest rates should have remained low. And if I'm going to compare the commenters in the comments section here to the Governor of the Bank of Canada, I'm probably going to take the Governor of the Bank of Canada's word for it prior to taking a commenter in the comment section's word for it. So the reality of it is there was just never this time where it made sense to lock in. In hindsight, yes, it may have, but with the information that we had at pretty much every point along the way, it just didn't seem to make sense. And that's why a lot of people have stuck with their variable rate mortgages. Now, combine all that with the fact that most people wanted to avoid those big 5-year fixed penalties, and that was a further deterrent to get into a fixed rate mortgage. And there's no point in beating yourself up if you made that decision, and there's no point in beating other people up if they made that decision, because honestly, it was the right decision at the time. Now, the Bank of Canada is also paying attention to the resale market. Obviously, the resale market has softened over the last couple of months. It is coming back to pre-pandemic levels, although it is still significantly higher than it was pre-pandemic. So while the market is correcting, it seems like it's going back to normal at this moment. Only time will tell if it dips back into these 2012 levels. Now, with respect to interest rates and where things are going, obviously, if there are lots of job losses, obviously, if there is a major reduction in home prices and less access to credit as a result, then that's going to basically be an amplifier to the downside of the economy. And the Bank of Canada is going to have to watch that. And if that happens, the prognosis with respect to where interest rates are going to go is probably going to shift. And at some point, we're probably going to see interest rates come back down. Now, could that be in the next 3 to 5 years before a bunch of these mortgages come up for renewal? Absolutely. And if that's the case, then variable rate mortgage holders may very well be happy that they held on to their variable rate mortgages. But if interest rates continue to go up and there's no relief in the next 3 to 5 years, there's going to be a lot of fixed rate mortgage holders and variable rate mortgage holders that have fixed rate payments that are going to end up in a whole world of pain. And I fully suspect that in 3 to 5 years, when they release the financial system report at that point in time, the number of mortgages that are coming up for renewal that are going to have to go into higher interest rates is going to be a major topic of concern if interest rates don't turn around. And I do believe that interest rates at some point will turn around, probably sooner than what the Bank of Canada is suggesting right now, because they've had to take a hardline stance, partly because of the political rhetoric that's been levied against them by the Conservative Party. And by the way, I am in no way a liberal, I'm in no way a conservative, but I do believe in common sense, and the attacks that the Conservatives are making on the financial system and on the Governor of the Bank of Canada are absolutely ridiculous, and they should be something that is completely disregarded by the majority of Canadians. If you're supporting them, you're doing bad things. That's the simple fact of it. But as a result of that political rhetoric, the Bank of Canada has had to take a firm stance saying that interest rates are going to rise. And whether they completely believe that or not, that is the circumstance we're in right now. The decisions we make today can only be made with the information that we have today. And probably the best way to determine if you should be in a fixed rate or variable rate mortgage right now is based on whether or not it's going to keep you awake at night, knowing that your payments or your interest rate could increase. And then you have to take a look at what that payment difference is and where you think interest rates are going to go. And you have to do the calculations and make the decision for yourself. Don't let some guy on YouTube make the decision for you or your banker make the decision. It's your responsibility to understand the differences in payments, the differences in costs, and the potential benefits and downfalls of taking that variable or that fixed rate. So I hope you found this video useful. If you did, do me that favor, hit that subscribe button, that notification bell, and that like button, and check out the video to the left and the right here for more information on this topic. We'll see you on the very next one. Cheers.